Alright folks, let's look at the second common AMT trigger. It's called accelerated depreciation. And I know it seems like a little bit complex because it may involve a little bit of accounting. Let me explain this for you, okay? So basically right now, the current US tax depreciation system is used as the markers. This is just most of business investment property used, called MACR markers. So it's a abbreviation of the modified accelerated cost recovery system. So in plain English, so for example, you invest, you buy some equipment, you buy some vehicles, you buy some machinery, right? And you are going to recover, or the current US tax system allows you to recover the cost of the assets faster in earlier years. So basically, it's an accelerated method. Okay, so basically, it allows you to accelerate and then switch to the straight line later. And you might wonder why this accelerated depreciation method that can trigger the AMT, remember, is alternative minimum tax. Why? Because there is a difference. As I said at the very beginning, as long as there is a difference between the regular tax system as well as the AMT, there will be a trigger. Okay? So, how is that so? Let me explain. So let me just give you some examples. So for example, at the markers depreciation, you might get like 200% of the decline balance. But under the MT system, you might just get the 150 or even like straight line. Okay, that means there's a time difference between the markers. Markers is kind of like a faster write-off. Okay, and AMT is just a more slower method. And so basically there's a time difference. And since the depreciation got a time difference, you can generate the AMT liability. Okay? You generate that now, but also gives you the AMT credit later. So as I said, it's a timing difference. So basically, right now it's an AMT liability, but later it's an AMT credit. So over the whole life of the asset, the total depreciation just equals out. Okay, the total depreciation is the same. It's just a timing difference. Liability now, credit later. Okay, I'm just to give you some a number to make you easier to understand. So for example, you bought $1 million of equipment as an investment. Okay, and if you're using the regular tax law under the markers, okay, you might deduct. Let me just some imaginary scenario. You might deduct I don't know, $400,000 at a year one. Okay, but this is the markers rule. But under the AMT rule, you may just only allow you to deduct $250,000. Okay, because as I said, AMT is a slower method. Markers is accelerated depreciation method, right? So this is a difference. Remember, the difference right now is the timing difference. Okay, it will equals out later, but right now at that specific year there's a difference. Okay, so if you just subtract 250 from the 400,000, you got the $150,000. Okay, and that difference is added back to the AMT. The alternative minimum taxable income, because there's a difference. So you know what? That's also be included back to the taxable income, right? So that's basically is as a kind of a trigger. You add it back, and you're going to pay more tax. Okay, but later you can just use that credit to reduce the tax. But remember, as I said at the very beginning, this is just a timing issue. So you don't need to worry about it, but you have to know that you build up the AMT credits and you have to use it. You build AMT credits that you can use in later years. So in the end, everything just equals out.